From Share Navigator, and just very briefly I want to show you one of the trades we did recently in our account. So this is an option trade, it was a bear put spread, and this is a debit spread. So when we talk about a debit spread, it just means we paid for this trade. If it was a credit spread, we would have got paid up front. So this is one that we paid out for. Okay, so what was the trade? Well, there's two parts of this trade. The first part was we bought the SPY, one contract. It was a put option. The expiry date was May 15th, and it was a $209 strike, and we paid out $441 for that. So this part of the trade is the bearish part of the trade. So in order for us to make money, when you buy a put option, you want the share price of SPY to fall. Now we offset the cost of that a little bit by bringing in a second leg of the trade. So in this scenario here, we actually sold the SPY $206 put for the exact same expiry. So this is the really important thing about doing debit spreads and this bear put spread. The quantities of the contracts on both sides of the trade will be the same, and so will the expiry dates. And in this case, we sold a 206 strike, and we took in premium for doing that at 329. So that's actually a bullish trade. If we were to place that trade on its own, we would want SPY to finish above 206. So how does this all compute out in terms of a profit and loss? Well, as always, I always encourage people to do a profit and loss statement for potential outcomes or potential what-if scenarios. So if we move down here, we can see we have a what-if scenario here. So what would happen if the share price of SPY finished at $200, for example, by the third Friday of May, or by May the 15th? 201, 202. So these are just potential price outcomes. We're just saying, well, what would happen if the share price went to this particular location? The second one here is we put in the information that we know. Well, we know that we bought an SPY May 15 209 put, and it cost us 441. So we compute that all the way across, or we fill in the grid lines all the way across for this particular one, because that's what we paid. That's known information. And the second part of the trade, we know that we took in premium of 329 for selling the 206 put. So the next stage is we got to put a value on both those two options at expiry. So we're assuming now it's fast forward the clock time. We're at expiry Friday. What is the value, for example, here of the $209 put? Well, the $209 put allows us to sell SPY to the market at $9. So there's $9 of real value in this particular put if the share price of SPY is at $200. So this is the in the money value, or the real portion value of that particular option. And just think about logically, if you've got an asset there that, or a piece of paper that allows you to sell something at a higher price than what it's currently worth, that particular contract has to be worth at least the difference between that. So the difference between 200 and 209 is $9. That's what it's worth. And we do that all the way across. That's something we own, so it's positive for us. Now, when we get to 209, there's now no value in that particular option. It runs out of, there's no time value, so there's no value there. Then we do exactly the same here for the 206 put, and this time you'll see a negative $6. So why is it a minus? Well, again, there's $6 of real value, or in the money value, of this particular option if the share price drops to 200, and we don't own that. We sold it, so it's negative for us. It's negative for us. Same with 201, negative 5, 202, negative 4, 203, and so on and so forth. But when we get to 206, there's no more value in that particular option, so they're in any other potential outcome. So all we're doing here in the profit and loss per share is adding up the four columns here, and we can see that if the share price drops to 200, we're going to make 188. Because we sold one contract, and in the options market, one contract controls 100 shares of stock, the profit is $188. And you can see that's the scenario here for all outcomes right up to 206. So once the share price of SPY finishes below 206, we're going to make $188 in this trade. At 207, we make $88. Then at 208, we start losing money. And the max we can lose is the amount we paid out. So we paid out $112 or $112 in total for this particular debit spread. So that's the max we can lose. So let's put this all into a little bit more simpler form. You can see here the maximum loss per contract is $112. Our maximum profit is 188. So that's a potential return on investment of 168%, which is pretty impressive. Now, the probabilities of success in this trade are only 56%. Now, that's one of the reasons why we place this trade. I'll talk about that in a moment. Normally, we would go for something that gives us 70 or 80% success or chance of success here. But there was another reason why we placed this trade, and I'll talk about that when we get onto notes. Our break even here is 207.88. So the break even for a bear put spread is simply the strike of the put that you bought minus your premium received. So minus or the premium you paid out, which was 112, and that's your break even on this. At the time, it was just a pure coincidence that the share price at that time was 207.88 as well. So just a pure fluke, pure coincidence. Now, the trade will be in pure profit here if the share price finishes below 206. The reason for the trade is that at the time of placing this, implied volatility is low. This is really important, and this is where a lot of people who trade options make mistakes. They sell options when volatility is low, and they tend to buy options when volatility is high, which is the wrong way around. When volatility is low, that's actually when debit spreads can become quite powerful. And at the time, the volatility on the SPY had dropped significantly. And we wanted to take advantage of that because historical studies will show that in the options market, volatility will eventually revert back to its mean at some point. So for example, if it's after dropping now suddenly, it will revert back to its mean at some point. And remember how options are priced. They're priced based on real value and time value, and volatility, implied volatility, is a critical part of that time value. So implied volatility has dropped, that means the value of the options may have dropped. And as they increase, what we're trying to take advantage of, as implied volatility increases, we make a profit out of that. So we want to take advantage of implied volatility increasing. Now, this is a type of trade you monitor, and normally you wouldn't let this play out all the way out to expiry. You would take it off when you get to a certain level. Now, we're looking to make a 50% profit, so our max profit here is 188. We'll probably take this off when we're in $90 of profit on this. And the reason is, between now and May the 15th, we reckon, there's a good chance of implied volatility spiking at some stage, and at that time, that's probably the best time to start looking at taking these trades off for a profit. In terms of a graph, this is what it looks like. You can see here, it's kind of the exact opposite of a bull put spread. You can see it's the total opposite, so we make money as the shares drop below here. Okay, so what does this look like in the platform? Well, here we are. Here's the trade on. You can see down here, the first part of the trade is the 209 put. This trade is actually only on about 2 days, and you can see that particular side of the trade is up $95. Then on the other side of the trade, which was the short put on the 206, we're actually down 74. So in 2 days, we've already made $21, and that's because there's been an increase in implied volatility in the SPY. So when the difference between those two here is $90, we're probably going to kill both of those trades. Pretty simple as that. Okay, that's it for now, guys. I hope that explains why we placed that trade, what you're looking out for. Always remember to use volatility to your advantage. Sell volatility when volatility is high. Buy options when volatility is low. Okay, this is Stephen Cox. This is Share Navigator. Thanks. Bye for now.